Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Corporate Valuation Methods, a guide to key techniques and their importance. Economic conditions. Economic trends and market shifts heavily influence corporate valuation. At a macro level, changes in interest rates, inflation, and GDP growth can boost or erode a company's perceived worth. When the economy expands, businesses often experience growth in revenue and profit, leading to higher valuations. Conversely, during recessions, reduced consumer spending can impact demand, making some companies less valuable. Market fluctuations also play a role. For example, a stock market rally can inflate valuations, even for companies with average financial health. On the other hand, downturns or unstable markets can create hesitation among investors, reducing a company's valuation regardless of its fundamentals. Additionally, external events like trade disputes or global pandemics can create ripple effects. These events often disrupt supply chains, alter demand, and force businesses to reevaluate costs. The result? A fluctuation in valuations that often feels beyond a company's control. Industry trends. A company doesn't operate in a vacuum, it's part of a larger ecosystem. Industry-specific trends can significantly impact valuation. For instance, demand in a high-growth sector like renewable energy often leads to inflated valuations, as investors bet on future potential. In contrast, industries facing technological disruption, such as print media, may see declining valuations. Competition also matters. Companies with a unique market position or innovative offerings may command premium valuations compared to peers. Similarly, industries with massive barriers to entry, like pharmaceuticals or aerospace, attract higher valuations due to reduced competition. Regulation is another factor. Changes in laws can help or hinder entire industries. For example, stricter emissions laws can push up costs for automotive manufacturers, impacting their valuation. Staying aligned with industry trends is crucial for stakeholders assessing corporate worth. Company performance metrics. Numbers don't lie, and a company's performance metrics are at the heart of its valuation. Key performance indicators, KPIs, can give a snapshot of overall health, growth, and profitability. Among the most important are revenue growth. Consistent increases in sales signal strong demand and potential market dominance. Profit margins. Higher margins mean the company earns more from every dollar of revenue, which translates into better efficiency and value. Debt levels. High debt can scare off investors, while low debt implies stability and financial health. Cash flow. Healthy cash flow ensures a company can meet its obligations, reinvest in itself, and weather challenges. Other metrics like customer acquisition cost, CAC, lifetime value, LTV, and return on equity, ROE, can also play a role, depending on the business model. Together, these KPIs act like the vitals of a business, giving a clear indication of where it stands and what its future may hold. Companies with strong metrics are often rewarded with higher valuations, while those struggling may face steep discounts, even if their market potential seems promising. Ultimately, these numbers form the foundation of any valuation exercise, grounding it in reality. Challenges in corporate valuation. Accurately valuing a company is no easy task. Even the most robust methods can stumble when faced with unpredictable variables. While the process may seem straightforward on paper, real-world valuation often reveals difficulties that can complicate decision-making and lead to vastly different opinions on a company's worth. Subjectivity in valuation. Corporate valuation isn't just about plugging numbers into formulas. It relies on assumptions, and that's where subjectivity enters the picture. Small changes in assumptions can lead to dramatically different outcomes. For example, imagine forecasting growth rates. Analyst A might predict steady, moderate growth based on conservative market expectations, while Analyst B sees booming expansion through aggressive market capture. Which prediction is more accurate? The answer often depends on perspective. Key areas where subjectivity comes into play include growth projections. Overestimating or underestimating future growth is common, especially in volatile industries. Discount rates. the chosen rate can significantly impact present value calculations in methods like DCF. A higher rate lowers the valuation, while a lower rate raises it. Market comparisons. Deciding which companies qualify as comparable leaves room for differing interpretations. These subjective elements aren't inherently bad, but they highlight why two experts assessing the same company might arrive at vastly different numbers. In the end, valuation is part science, part art, and that art depends heavily on who's holding the brush. Data availability and quality. Valuation is only as accurate as the data it relies on. Unfortunately, finding reliable, up-to-date information isn't always straightforward. Incomplete or inconsistent data can skew results and create uncertainty. Challenges related to data include limited transparency. Many private companies don't share detailed financials, making it hard to assess their true value. Outdated information. Market conditions change quickly. Using old data can lead to incorrect assumptions about a company's current position. Data integrity. Even small inaccuracies, like errors in financial statements, can trickle down and have a large impact on calculations. Inconsistent sources. Comparing metrics across different platforms or databases may yield conflicting information, complicating analysis. Think of data as the foundation of a house. A strong, reliable foundation can support robust conclusions, while cracks or weaknesses lead to doubts. Public companies often have more accessible data, but even here, external factors like economic shifts can render numbers outdated almost overnight. Getting high-quality data isn't impossible, but it takes time, effort, and access to the right resources. And even then, there's no guarantee the data will cover every angle needed for an airtight valuation. The role of valuation in mergers and acquisitions. Valuation is the backbone of any merger or acquisition. It ensures both parties understand the financial implications of the deal and provides clarity to negotiate and integrate effectively. Without a proper valuation, the risks of overpaying or underestimating a company's potential multiply. Valuation during negotiations. In negotiations, valuation acts as a guidepost. It helps buyers and sellers establish a fair price while ensuring expectations are realistic. Think of it as a middle ground, the number that sets the tone for every discussion. How does valuation shape negotiations? Defines the starting point. Buyers know the maximum price they're willing to pay, and sellers understand their baseline. Justifies each party's position. An accurate valuation supports arguments during tough discussions, especially when deal terms need adjustment. Tailors deal structures. Some deals involve cash, stock, earnouts, or other complex components. Valuation ensures these pieces come together cohesively. For example, in an acquisition, if a buyer values a company at $100 million, that figure influences how stock shares or installments are distributed. Consider it a blueprint. Without it, decisions feel like guesswork. There's also a psychological aspect. When both sides agree on a valuation range, mistrust or disputes over pricing can be minimized. This cooperation encourages smoother negotiations and fewer last-minute surprises. Post-merger integration valuation. Valuation doesn't stop once the ink dries on the contract. After a merger or acquisition, companies often re-evaluate the new entity's worth. Why? Because integration is full of unknowns, and assumptions made during the deal may no longer apply. Post-merger integration valuation serves multiple purposes. Assesses the combined value. How do the two entities create synergy? Are efficiencies being realized, or have costs risen unexpectedly? Adjusts for market changes. A company valued 6 months ago may no longer reflect current market trends or economic conditions. Tracks goal achievement. Were projections accurate? Revisiting valuation helps measure success against original forecasts. Let's say a tech company acquires a smaller firm for its innovative software. During integration, they find unexpected costs in consolidating systems or retaining key talent. Reassessing valuation helps ensure the combined operation is still worth what the buyer expected, or highlights areas to fix. Neglecting post-merger valuation can blindside leadership with unanticipated risks. It's like skipping a health checkup after running a marathon. It ignores the toll the race might have taken. Ultimately, consistent valuation throughout the M&A process, both pre- and post-deal, keeps the focus on measurable results and long-term success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.